This is Business Live with me, Ian King, in Cambridge. The top business stories today. The Chancellor unveils what he says is the biggest business tax cut since the 1980s in his autumn statement. We'll get business reaction from here in Cambridge and from the Chief Executive of the UK's largest listed technology company, Sage. Plus all the latest markets reaction too, with pub stocks among the gainers as alcohol duties are frozen. Good afternoon from the Evolution Business Park here in Cambridge. This is Business Live with me, Ian King. The Chancellor, Jeremy Hunt, has unveiled what he claims is the biggest package of business tax cuts in modern history. He called it an autumn statement for growth, despite the Office for Budget Responsibility painting a gloomier picture of the UK economy over the next 4 years. Well, let's get some immediate business reaction now to the Chancellor's autumn statement. I'm here at the home of Nyobolt, a company that sums up what the Chancellor is trying to encourage, a state-of-the-art tech firm in the heart of what the government wants to be the UK's own Silicon Valley. Nyobolt's technology enables ultra-fast charging for electric vehicles and extends battery life. It's just unveiled its latest piece of technology, a mobile DC supercharger, which it says could be a game-changer in terms of the UK's charging infrastructure. Well, joining me now is Dr. Sai Shivareddy. He's Chief Executive of Nyobolt and co-founder, I should say, as well. Sai, what was your broad reaction to the autumn statement?
It was in line with expectations since what we've been hearing since Mansion House reforms, as well as what we heard last week in relation to the investment for the advanced manufacturing industries and also investment in the clean growth sector, especially the Green Accelerator. I'd like to know a little bit more about how that's going to be rolled out, but we'll look forward to hearing more.
Obviously, the expensing regime has been made permanent. Is that big for a company like you that invests very heavily?
Well, that's good for companies that are making profits, and we're a startup company that usually takes a few years before you get into profit. So what was good to see was the R&D tax credits being mentioned and being simplified. So again, some of the details would be great to go into. Didn't have time to look into it, but yeah, broadly looking forward to a better way to support early stage companies, especially the kind of industries that we want to create that are going to be the big growth factories.
Now, one thing that was very interesting, you were showing me around the site here earlier on, and one of the things that you mentioned was that it's been very, very difficult to get the power supplies that you want here. Grid connectivity is a big issue. The Chancellor directly mentioned that in his speech.
Indeed, this was something we've been talking about also with various bodies in the last 6 months. I was happy to hear that mentioned in the statement. So there's a big problem here with just the amount of power that's required for us to be able to roll out this type of charging infrastructure, as well as build and test these types of batteries. We need a lot of power coming to these sites, and it's very expensive. And that's not the only problem, right? It takes at least a year to get the power to the site. For instance, this site, we've been asking for up to 2 megawatts since we moved in, and they kept telling it's taking a good part of a year to get in, and that's a long time in the history of a company that's only 3 years old. So we look forward to the replacement to these planning laws that allow people to just start getting these things, and also get a bit more of the private sector involved to start getting more power.
I mean, implicit in it, though, to me, was the fact that you might have to pay a bit more for planning consent. But is that worth it if you get a more rapid decision?
Rapid decision wins any day over the cost, because the cost of not doing anything is huge for us.
Yeah, absolutely. Now, one of the things that struck me has been quite interesting. The Office for Budget Responsibility cut its forecast for electric vehicle sales in coming years. Obviously, this is your sector, that you're geared to this. Were you surprised by that?
I am surprised by that, but we've been hearing some of this news in the slowdown in the last 6 to 9 months. But that's been broadly in line with the market conditions. So I'm not entirely sure how that forecast has been predicted as a result of something near term, or some of the things that we've been hearing is the backlash against the things that people expected last year, just in terms of the convenience. And we've been talking about this earlier, where people want to do good for the planet, but if you have to go backwards in convenience, it's not necessarily that easy to make that transition. So some of the technologies that we're working on are going to help make that transition as seamless as possible. So it may not happen in the next 3 years, but the trend in general is towards cleaner and more efficient transport.
And was there anything missing today that you'd have liked to have seen?
Well, there should be some clarity on a bold vision to compete globally. This clear industrial strategy, again, I didn't fully expect it to come from the Chancellor, but at least in the coming days, look forward to hearing from the Secretary of State as well and the other additional comments around what they're planning to do with the remaining time that they have.
Okay, so
they're looking forward for the next decade, which was good to see. I quite enjoyed thinking about the future and the positive outlook in general.
Absolutely. Well, if I've learned one thing today, it's that this is a forward-thinking business and no mistake. Si, thanks very much for hosting us today. Do appreciate it. Thank you.
Thank you.
Well, let's get some more business reaction now to today's autumn statements. The Sage Group is a FTSE 100 accounting software company based in Newcastle upon Tyne, and it's the UK's largest listed technology company. Its shares jumped earlier on today by 13% to an all-time high, and that was after it reported an 18% rise in full-year underlying operating profits of £456 million. Well, joining me now is Steve Hare, the Chief Executive of Sage. Steve, good to see you again. Before we talk about your results, give me your reaction, please, to the autumn statement.
Well, good afternoon, Ian. I think the news is it's great to see the Chancellor talking so much about business, so to see such a large amount of the speech dedicated to talking about businesses and also particularly talking about the packages for small businesses. So that's to be welcomed. The focus on growth is to be welcomed. But on the other hand, I think a little bit of a missed opportunity because we've been lobbying for more incentives to invest in the technology that actually enables the productivity. So I think it's great to see the full expensing, but that really drives investment in plant and machinery and infrastructure, as opposed to the technology applications that are required to drive the digital economy. So we'd have liked to have seen more around that.
Steve, have you run the numbers? Do you know roughly how much you'll benefit from full expensing?
I don't think we'll benefit at all because our capital expenditure is extremely low. So as I say, it's really designed to drive infrastructure, drive plant and machinery. You know, we're a service software business and it really doesn't have a material effect. And I think a lot of our customers are the same. A lot of small businesses are service businesses, they provide services, and therefore full expensing really does not benefit them.
What about the changes to the R&D credit scheme? I mean, obviously, a lot of your customers are SMEs. This is something that directly impacts on them.
Yeah, I mean, again, as I say, that is to be encouraged. It's great that the government is trying to continue to incentivise investments to be made in this country to develop IP here, to continue the research into AI, etc. And we employ a lot of engineers in the UK, particularly up in Newcastle, and we'll continue to do that. But I think the most important thing is if you want to drive the economy and you want to drive particularly the economy digitally, 98% of the businesses in the UK are small, mid-sized businesses. And that's where I'd really like to see the incentive for growth focus.
Were you happy at what was said about the skills agenda? I mean, clearly the Chancellor has diagnosed that there is a real issue with people of working age who aren't in the workforce, and a lot of those don't have the requisite skills to be in work. Has he gone far enough in trying to re-equip some of those people with the skills that they require for the modern economy?
Yes, I think the focus is good, but I think, again, by embracing the latest technology, embracing what we can do with the digital economy, and then fully getting the benefits of artificial intelligence and the technology that's available, we can then equip more people to be able to make a bigger contribution to the economy. So I think it's important that as we get more people into the workforce, we do equip them with those digital skills. And so that skills training is equally as important as the incentives to get back into the workplace.
And I know it's something you take very seriously. Well, looking at your results today, Steve, obviously a big increase in revenues. How did that break down between volume and mix? I know you've been putting on a lot of new customers.
Yeah, we are. It was pretty balanced, actually, in terms of driving both new customers and also continuing to see growth from our existing customers. It was also very balanced geographically, actually the highest growth being in the US, which is also our biggest market. But we did also see strong growth in the UK and starting to see accelerating growth in Europe. And actually in Europe, where we're now, really delivering our global products, we're also seeing governments in Europe really starting to embrace initiatives like electronic invoicing to try and drive digitization across the European economies. And that's good long term for growth because we have the applications to support that.
But briefly, Steve, what proportion of revenues now come from cloud-based services?
Yeah, so we about 80% now, 85% of revenue comes from Sage Business Cloud. So either native cloud, so fully cloud or connected cloud. And of that, about half is fully cloud native and about half is cloud connected. But what we're doing now through the network is delivering more and more of our new services to all of our customers through that network, which is fully cloud. So this is really what's driving our growth. And we saw a 25% growth in revenue from those cloud products. So as I say, it's about 85% of revenue now.
Which I think is more than where you said you'd be a couple of years ago, Steve. We've got to leave it there. Really appreciate you joining me on such a busy day. Thank you.
Thank you.
Well, joining me now is Richard Hughes. He's chair of the Budget Watchdog, of course, the Office for Budget Responsibility, or the OBI. Richard, welcome to you this afternoon. I mean, Mr. Hunt described this as a tax-cutting autumn statement. You actually have tax rising as a proportion of GDP in coming years.
That's right. The tax burden is still rising over the next 5 years. It's rising about 4.5% of GDP, up to 38% of GDP by 2027-28. That would make it the highest tax burden in the post-war era. The measures in this autumn statement do offset some of that increase in the tax burden by about 0.5% of GDP, but overall it's still rising by around 4.5% over the next 5 years.
Now, you've cut your growth forecast for UK GDP for both next year and 2025. What informed those cuts?
So it's partly that what we've discovered since our March forecast is that the economy made more of a recovery from the shock of the pandemic and from the shock of the energy crisis. So the economy has actually been operating 2% above its pre-pandemic level. We thought back in March that the economy was operating at 1% below its pre-pandemic level. So more of the recovery from the pandemic and from the energy crisis has already happened. That means there's less of a gap to make up going forward. Also, we've got higher interest rates. That weighs on household finances, that weighs on businesses, and that means that it reduces investment and also reduces consumption over our forecast. And also, we made some changes in light of demographic change. More of the population is shifting into older age groups. That means people work fewer hours, and that means also growth in overall hours worked in the economy and overall levels of economic activity slows down. And that means that we've reduced our long-run growth forecast by about 0.1% of GDP from 1.8 down to 1.6.
I mean, at the heart of that, Richard, is weaker productivity. Do you think any of the measures on the supply side that the Chancellor's announced today are perhaps going to boost productivity growth more than a lot of people are assuming?
So when we looked at it, we did think that the measures the Chancellor's taken in today's autumn statement, both to boost business investment, but also to increase the labour supply, add about 0.3 percentage points to the level of GDP by the end of our forecast period. So that's a modest boost to the supply side of the economy. You get about £14 billion worth of extra investment, we think, from the decision to make full expensing permanent. We think that the measures on the welfare side get an extra 50,000 people into the workforce, and so it does boost the workforce. It does boost investment. It gives you a modest boost to the level of output in 5 years' time. As I said, about 0.3%. It's worth having, but it's not getting us to something like pre-financial crisis levels of productivity growth, pre-financial crisis levels of GDP growth. But it does make a material difference.
Now, you've had to make some quite serious revisions, as we said. You were originally predicting a 0.2% contraction in the economy this year. You've revised that to 0.6% growth. That's a really, really big revision that has all sorts of real-life consequences. Are you satisfied with your forecasting?
So it's a very challenging environment in which to make economic forecasts. We've seen huge shocks to the UK and economies around the world, from the pandemic, from the energy crisis. Also, trying to judge the pace of the economy's recovery from those crises is challenging. We've had big revisions to ONS data. They've told us that the economy is 2% larger than we thought it was back in March. So we're adjusting to our new understanding of history, but also the world in which we're forecasting, and the world in which all of us are managing our finances is changing. Energy prices, quadrupled. Then they came back down dramatically over the last 6 months. Interest rates have shot up. All those things have big impacts on the economic outlook, which we have to adjust for every time we make a forecast. A lot changes over the course of 9 months in the UK economy at the moment. Taking account of those changes does really change your view of where the economy is going, over the next 6 months, but also over the next 6 years.
OK, Richard Hughes, really appreciate you joining me this afternoon. Thank you very much.
Thanks, Ian.
Well, still to come on Business Live, we'll have a look at how the markets have fared this afternoon. Don't go away.
A lot of people come to us for well-being aspects. People who suffer from anxiety. We often get people who message me and say, I know someone that's autistic. I think they benefit from this. Other people really just love cows already and want to spend some time with them. The problem with cows is that they're so big. Generally, cows are quite inquisitive. They are, on the whole, very friendly. I mean, I would say don't just go and approach a cow in the field because you just never know. These are ones we've worked a lot with. We knew they were already friendly and confident. They're really used to seeing people now, and they do actually love the attention. They're really enjoying having people here to see them. This is Cuddle Puff. She's a British Blue Cross. The rest of our cuddle cows are dairy crosses. When we had dairy herd up to last year, we sold those because of the flooding in the area, and we kept these because we just couldn't bear to part with them. They were our friends. £40 at the moment, and that lasts about 2.5 hours. We meet the cuddle cows for about 3/4 of an hour, and then we meet our little Highlands as well. Really popular. We put tickets on sale, and we sell out usually within about half an hour. But we only take 6 people at once. There's three of us farmers, my husband, my brother and myself. So one of us will just spend time with each couple, telling them about the cows, making sure everyone's safe, and making sure they have a really nice time.
Slide yemiyor. Slide better. Fly Emirates. Fly better.
Thank you.
Well, let's have a look at how the markets are doing this afternoon in the wake of the Chancellor's autumn statement. Obviously, the gilt market is the first place that one looks at for reaction on the public finances. A little bit of a sell-off. The 10-year gilt yield ticked up, not by a great deal, but by the highest level for a week is where it stands now. On the foreign exchange markets, well, the pound weakened slightly against both the US dollar and the euro. Today, though, really is a day of dollar strength. As you can see, the euro is also off against the greenback right now. On the equity markets, well, the FTSE 100 finished off just under 1/6% lower. Interesting to note, though, some of the pub stocks were up. All of these outside the FTSE, the likes of JD Wetherspoon, Marston's and Fuller Smith and Turner. That, of course, in reaction to the freezing on alcohol duties. Among the biggest gainers today, we've been speaking to them on this programme. Sage up by just over 13% on its better than expected results, and there was a share buyback too. Among the other gainers, BT Group finished up higher. I think they're probably a key beneficiary of the Chancellor's full expensing announcement. Meanwhile, JD Sports finished nearly 4% to the good. That was after it got a push from one of the brokers, I think Bank of America, doing the honours there. Among the fallers, Kingfisher, Europe's biggest do-it-yourself chain, owner, of course, of B&Q and Screwfix, that finished off more than 6%, as you can see there, after it cut its full-year profits forecast. In mainland Europe, well, all of the main continental European markets have finished in positive territory. On Wall Street, similar situation. The Nasdaq currently trading up 0.5%. Over to the oil price, we've seen another big drop today. Barrel of Brent crude, I think, will cost you subsequently $79.31 a barrel. That's off more than 3% on the session. Well, joining me this afternoon is Lucy Coutts, Investment Director at JM Fin. Lucy, good to see you this afternoon. Now, one of the things that we got in the autumn statement was a possible retail sale of shares in NatWest, of course, still owned by the government. What do you make of that?
Yes, I mean, they've always had a soft target of exiting NatWest by 2025, 2026. And by way, I mean, it seems a long time ago, but the government funded or bailed out NatWest in 2008, 2009, spending about £46 billion in total. They've realised since 2015, when they had at their peak 84% of the shares of NatWest, they've started selling that stake down to just over 38%. And that's the bit that they're looking to sell. Now, NatWest shares are actually down 20% in the year to date. And having looked at the sort of sales in the history, the UK taxpayer is going to lose around about £27 billion on this investment.
Yeah, absolutely. I mean, thinking back to those great privatisations of the past, I mean, they were always priced to go in the vernacular. What sort of discount might NatWest shares be sold at to the prevailing market price, do you think?
Well, it's a substantial stake. I mean, one could argue that maybe NatWest is undervalued at the moment because of the government stock overhang. And I mean, certainly past sales have been at sort of smaller discounts, so sort of 3% or thereabouts. But it depends who the buyer is. Is it going to be NatWest Group, or is it going to be sort of through an open market trade? Both routes the UK government has taken in the past.
Yes, it was notable. Mr. Hunt used he referred to SIDS, didn't he? Of course, that was the expression used when British Gas was privatised back in 1986. I have to tell you, some of the younger members of our crew here in Cambridge, that reference went right over their head. I mean, he's going to have to go some to try and rekindle the spirit of popular capitalism, isn't he?
Well, he is, and you and I can both obviously remember Sid. I did smirk a little hearing that reference. Yeah, I mean, I personally, you look at the quality of a company like Sage with great results and such pride that, it's not going to look at a listing in the US. It's the forefront of technology. But, a UK domestic bank, are investors really going to look at that, for future investment? It's a difficult one.
It really is. What about Kingfisher, Lucy? I mean, another set of disappointing numbers from them today.
Yeah, they've got softness in France, which is their main market. So they're seeing a sort of slowdown in consumer demand. But here in the UK, it's resilient, Screwfix and B&Q. But they've got a much better digital offering here in the UK. And I wonder if that's where they're going to make the adjustments, overseas, and see if that can improve sales over there. But we did see a share buyback, and we know it's again sort of symptomatic that the consumers are beginning to feel the pinch with the interest rate rises.
Yes, and not just here in the UK, but also in the United States, where we heard from Lowe's yesterday. Very similar business to Kingfisher, and again, an earnings downgrade from them.
Yes, it is pretty much across the board. And every business is subject to the consumer, whether it's the stuff that fills our cupboards, which are consumer staples, or whether it's those that are more discretionary spend. But you can see that companies are now beginning to warn on future earnings. And this was always baked into the market. And I think analysts have got to sharpen their pencils going forward, because the consumers, certainly there is evidence that companies are beginning to lose traction a little.
OK, Lucy, got to leave it there. Good to see you as ever. Thank you.
Thank you.
That's it from me. A big thank you to our host, Nia Bolt, here in Cambridge. I'm back again tomorrow morning with our next edition at 11:30 tomorrow morning. Hope to see you then. Do stay tuned. Mark Austin's up next. Cheerio.